$1,000. That's it. That's less than most people spend on a single month of rent, and I'm about to show you how that exact amount can be enough to put your name on a piece of land and a home of your own. Now, before you roll your eyes, let me be honest with you up front, because this is where every fake guru loses you. $1,000 will not buy you a mansion, and anybody promising you a free house is lying to your face. But the real, legal, boring on paper strategies that let regular people get in the door for around $1,000.
Economists expect a modest housing reset next year, with more homes coming to the market and price growth cooling after years of tight supply. Analysts are predicting recovery from high prices is likely to be gradual, not a quick turnaround.
Those are very real. Most people have no idea they exist. And by the end of this video, you're going to understand exactly how the pieces fit together. So let me start by killing the lie that's keeping you renting. Here's the belief that traps almost everyone. You think you need 20% down. You've heard it your whole life. On a $300,000 home, that's $60,000 in cash, sitting in a bank account, before anyone hands you a key. And when you look at that number against your actual savings, you quietly decide that homeownership is for other people. People with rich parents. People who earn more than you. Not you, not now, maybe not ever. That 20% figure is the single most expensive myth in American real estate because it stops people from even trying. The truth is that 20% down is just the threshold to avoid one specific type of insurance.
Buying a home slightly more affordable than it has been. We're talking about marginal improvements, not a big takeoff for the housing market.
And good news for mortgage rates. Realtor.com sees mortgage rates falling to 6.3% from an average of 6.
It is not and has never been the minimum to buy a home. There are entire loan programs backed by the United States government built specifically so that working people with almost no savings can become homeowners. The down payment was never the wall you thought it was. The wall was that nobody ever sat you down and explained the doors. So that's what I'm going to do. I'm going to walk you through the actual doors, one at a time, and show you how stacking the right ones together gets your out-of-pocket costs down to around $1,000. If you want help putting all this into action in your own situation, grab our 2026 Housing Survival Guide. It's a simple, easy-to-follow playbook showing you how to protect your home equity, avoid costly mistakes, spot crash risk markets, and find hidden real estate opportunities. The average reader could save or avoid losing thousands of dollars by making smarter decisions. The link is in the description.
A rule that could bring major changes for home buyers is receiving some backlash. It's all part of an effort to make home buying more affordable with those with limited income, but it could mean higher costs for buyers who have a good credit.
Some of these you'll qualify for, some you won't. But I promise you, at least one of these paths fits more people than you'd ever guess. And the last strategy is the one that lets you buy raw land and build, even if a bank has already told you no. Let's start with the most powerful door of all, the one that asks for literally nothing down. There are exactly 2 mainstream loan programs in this country that let you finance 100% of a home's price, meaning $0 for the down payment itself. Zero. And understanding these two is the foundation for everything else. The first is the VA loan. If you are a veteran, an active duty service member, or in many cases a surviving spouse, this is the single best deal in American housing, full stop. A VA loan requires no down payment at all, charges no monthly mortgage insurance, and tends to come with lower interest rates than you'd get otherwise.
So I'm thrilled to sign the VA Home Loan Program Reform Act into law, and that is something that they've wanted to do for a long time.
The government effectively backs the loan, so the lender takes on less risk and you reap the reward. If you've served and you're sitting there renting, you may be leaving one of the most valuable benefits you've ever earned completely on the table. The only catch is you have to qualify through your service record and intend to live in the home as your primary residence. But if that's you, the door is wide open. Now, most people watching aren't veterans, so stay with me, because the second door is open to millions of regular civilians, and almost nobody uses it. It's called the USDA loan, and the name is the most misleading thing about it. People hear USDA, they think farms, they think you have to live in the absolute middle of nowhere. That is not how it works. The USDA loan is a zero down payment mortgage backed by the government for what they call rural and suburban areas. And here's the shocking part. Something like 97% of the land in the United States qualifies geographically, including many suburban areas near major cities. There's a free map online where you type in an address and it tells you whether the home is eligible. So what's the trade-off? The USDA loan is designed for low to moderate income households, so there are income limits. In 2026, for a household of 1 to 4 people, you generally need to earn under roughly $112,000 to $120,000 a year, depending on your area, which honestly covers a massive share of working family. You'll typically want a credit score around 620 to 640 or higher, and it has to be your primary residence. There's a small annual fee baked into the payment in place of traditional mortgage insurance. But sit with what this means. If you earn a normal income and you're willing to look just outside the city center, you can finance a home with nothing down. The down payment, the thing you thought was impossible, drops to zero.
They're really there to sort of promote equitable access to home ownership, because right now in this country, we have still low inventory, high interest rates, and the average price of a home right now, a selling price in this country, is over $420,000. So in a nutshell, people with lower credit scores may get a break on their mortgage fees with these new rules.
But here's where everyone gets confused, and it's the most important distinction in this entire video. Zero down does not mean zero cash. And this is exactly where that $1,000 figure comes from. This is the part the gurus skip, because it's not sexy, but it's the whole game. When you buy a home, even with a zero down loan, there are still costs that exist outside the down payment. There's the home inspection, there are appraisal and lender charges, and there are prepaid escrow items, which is just money set aside up front for your future property taxes and insurance. Bundle all of that together with the official closing costs, and on a normal purchase you might be looking at several $1,000s in cash, even with zero down on the actual loan. So how do we get that down to $1,000? 2 words: other people's money. And I mean that completely legally.
Life example for folks so they can get a feel. So if you have a $300,000 loan at a credit score that's less than 659, meaning it's not great, you could save $3,750 in closing costs. Now,
the first source is down payment assistance, and the scale of this is genuinely staggering. There are over 2,000 down payment and closing cost assistance programs across this country, run by state housing agencies, counties, and cities. Many of them offer grants, actual money you do not pay back, while others offer forgivable loans, which means after you live in the home for a few years making your payments on time, the help simply disappears and you owe nothing. Depending on the program, these can hand eligible buyers anywhere from a few $1,000s up to $25,000, and crucially, many of them can be used not just for a down payment but for closing costs too. Most require you to be a first-time buyer, or at least someone who hasn't owned in the last 3 years, to fall under an income limit, and to take a short homebuyer education course that's often free and online. But the money is real, and the tragic part is that most eligible buyers never even apply, simply because they have no idea these programs exist. And it gets better, because some of these programs are cleverly designed so you never feel them at all. One common structure is what's called a silent second mortgage. The assistance money comes to you as a second loan, but it charges 0 interest and requires 0 monthly payments. It just sits quietly behind your main mortgage. With some FHA-paired programs, for example, that second loan covers your entire 3.5% down payment. And then, as long as you make your regular mortgage payments on time for a set stretch, often around 3 years, that second loan is forgiven and erased completely. You got the down payment money, you never made a payment on it, and then the debt simply vanished. That is not a loophole. That is a program built on purpose to get working people into homes, and it's sitting there unused in nearly every state. The second source is the seller themselves. In a market where buyers have more power, which is much of the country right now, you can negotiate for the seller to pay a chunk of your closing costs. It's called a seller concession, and it's written right into the offer. The seller agrees to credit you a few $1,000s at closing to cover those fees, in exchange for a smoother or faster sale.
Some of that gain is because homes are just sitting and not selling. There was actually a pullback in new listings in June. Regionally, though, sales dropped everywhere except in the Northeast, which is kind of weird because home price growth.
So now picture the stack. You use a zero down USDA or VA loan, so the down payment is nothing. You use a down payment assistance grant and a seller concession to wipe out most of the closing costs. And what's left for you to physically bring to the table? Often just your earnest money and inspection, which can land right around that $1,000. That's not a trick. That's just knowing how the pieces fit. Let me walk you through exactly what that stack looks like in real life, with real numbers so it stops being abstract. Say you find a home for $250,000 in a USDA-eligible suburb. On a traditional path, you'd be told to bring $50,000 for the down payment, plus maybe $8,000 in closing costs. $58,000. Game over for most people. Now run the other path. The USDA loan covers 100% of the price, so your down payment is zero. You apply through your state housing agency and get approved for, say, a $7,000 forgivable grant that wipes out almost all of your closing costs. You write into your offer that the seller credits you another $2,000 at closing. Now, the only cash you personally need is the earnest money you put down with your offer and your inspection fee, which together come to roughly $1,000. Same house, same price.
Definitely made the playing field better for the buyer, because now the buyer feels like it's not going to just keep going up, up, up. They have that time to secure the property, put it under contract, get it appraised, and lock in a good rate.
The difference between $58,000 and $1,000 wasn't luck or income. It was knowing which 3 doors to open in the right order. Now I told you we'd also talk about land, raw land, the kind you build on, because the door to land works completely differently, and it might be the most overlooked strategy of all. Banks generally hate lending on vacant land. There's no house to repossess, so they see it as risky, which means traditional land loans usually demand big down payments and high rates. But there's a way around the bank entirely, and it's been around for generations. It's called owner financing or seller financing. Here's how it works. Instead of getting a loan from a bank, you get it directly from the person selling the land. The seller becomes your bank. You sign a contract, you agree on a down payment and a monthly payment, and you pay the seller directly every month instead of a lender. There's no bank appraisal, no rigid debt-to-income formula, and these deals can close in as little as a week instead of months. Why would a seller do this? Because it lets them sell hard-to-move land faster and turns their property into a steady stream of monthly income with interest. In huge swaths of the country, in states with cheap, abundant land like New Mexico, Arizona, West Virginia, Arkansas, Mississippi, and rural parts of Texas, there are active markets of sellers offering exactly this, some with very low or even no money down. Suddenly, $1,000 isn't a down payment on a structure. It's the entrance fee to owning a piece of American dirt outright, on a payment plan you arrange directly with another human being. But, and this is a big but, I would be doing you a disservice if I didn't stop and warn you about the trap inside this one. So let me pump the brakes, because this is where people get hurt. Owner financing has a dark side, and it has a name: the land contract. In many of these private deals, the seller keeps the legal title to the land in their own name until you've paid the entire thing off. That sounds minor. It is not. It means if you fall behind on payments, in many of these contracts, the seller doesn't have to go through a long foreclosure process. They can simply reclaim the land and, under what's called a forfeiture clause, keep every single payment you've already made. Your down payment, your monthly checks, all of it, gone, and you walk away with nothing but a lesson. Private land deals also tend to carry much higher interest rates than a bank, often in the range of 8 to 15%, because the seller is taking on more risk. None of this means owner financing is bad. Millions of people have built homesteads this way. It means you read every single line of that contract, you understand exactly what happens if you miss a payment, and ideally you have a real estate attorney look it over before you sign anything. The strategy is powerful. The fine print is where people bleed. Okay, so you've got a path to a home and a path to land. But what if you want both at once? The land and a brand new home built on it. There's a loan for that too, and it's the one almost nobody talks about. It's called a one-time close construction loan.
President Trump signaling aggressive housing reforms beginning in 2026. He's aiming to boost affordability by cutting regulations and speeding up home construction.
And both the FHA and the VA offer versions of it. Here's the beauty of it. Instead of getting one loan to buy the land, then scrambling for another loan to build, then refinancing into a mortgage, this single loan wraps the construction, the lot purchase, and the permanent loan all into one mortgage and one closing. The FHA construction version is especially forgiving. It's open to people with credit scores as low as the 500 with a low down payment, and the catch is simply that you have to actually build a home you'll live in, not just sit on empty land. For a lot of people in cheaper parts of the country, building a modest new home this way can come out costing less than buying an existing one, and you end up with land and a house that's brand new, all financed together. No second loan, no refinance scramble, no paying closing costs twice. You sign once, The loan pays for the dirt and the build, and when the house is finished, it quietly converts into your regular mortgage. For the right person in the right area, it's the closest thing there is to buying land and a home as a single package. So now let me pull this all the way back, because the individual doors matter less than what they reveal when you see them together. Look at what we actually uncovered. The down payment, the thing you were taught was the impossible wall, can be zero through a VA or USDA loan. The closing costs, the hidden cash that trips everyone up, can be covered by someone else through one of thousands of assistance programs or a seller concession. Land that banks won't touch can be bought directly from a seller on a monthly plan, and land and a home together can be financed in a single loan even with rough credit. Stack the right ones for your situation, and the cash you personally need to bring shrinks down toward that $1,000 number that sounded impossible 8 minutes ago.
So let's talk about what we can do in terms of putting some sort of housing allocation where if you're a first-time home buyer, you can put money in there with an employer that's tax-free. I mean, I think there's ways to start thinking about the housing market and helping Gen Z save for their future rather than telling them they're just completely priced out.
Here's the real lesson, and it's bigger than any single program. The barrier to owning property in this country was almost never really about money. It was about information. The people who stay renters forever aren't the ones who can't afford it. They're the ones who never found out the doors existed, who believed the 20% myth, who assumed every path required a fortune they'd never have. The people who break through aren't richer. They're just better informed. They knew to check the USDA map. They knew to ask their state housing agency about assistance. They knew to read the land contract before signing. That knowledge, not a pile of cash, is what actually moved them from renting to owning. And I want to be straight with you, because trust is the only thing I'm selling here. None of this is a magic button. Every one of these doors has real requirements, income limits, credit checks, paperwork, and patience. You will have to qualify. You will have to do the work of applying and reading and asking questions. I'm not a financial advisor, and your exact situation deserves a real conversation with a qualified lender or housing counselor who can look at your actual numbers. But the difference between you and the homeowner you envy was never $60,000 in the bank. It was the willingness to learn which door is yours, and then walk through it. So here's what I want you to do. Don't let this video be another thing you watched and forgot. Go look up your state's housing finance agency. Type an address into the USDA eligibility map. Ask a lender the question you've been too intimidated to ask. The $1,000 was never the hard part. Believing you were allowed to start, that's the hard part. And now you know better. If this opened a door you didn't even know was there, do me one quick favor and subscribe to Bricks Market. This is exactly what we do here. Take the confusing, gate-kept world of real estate and break it down so regular people can actually use it to build something real. Hit that subscribe button, stick around, and I'll see you in the next one.